Well, good afternoon and welcome to HYROX's weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. Now, we invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson. My partner and colleague Paul Tepsich, the founder of HYROX, is also with us, as is our financial planner and wealth forecast specialist, Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Let's start with a quick review of our themes for 2017. We think that our strategy of having a tactical perspective to investing becomes even more important in 2017 because of the even greater levels of uncertainty imposed on us by a number of developing factors. If the new U.S. administration is able to push forward some of its tax proposals and spending initiatives, there is a greater likelihood of inflation, and the expectations surrounding this will change the dynamic in financial markets. To a large degree, bond markets have been showing this to us already. Higher bond yields and higher short-term rates in the U.S. with 2 or 3 more Fed rate increases will increase the cost of borrowing, which in turn could present us with a whole new set of risks with global debt levels at record highs. With improving economic conditions and a lower tax burden, it is expected that earnings will grow at an approximate rate of about 11.5% in 2017. However, this appears to be more than priced in to current equity markets at the moment. And it remains to be seen how the new populist revolution will play itself out, but first we had Brexit, followed by Donald Trump's election, and then the Italian referendum, and we also have upcoming elections in the Netherlands, France, and Germany. So there are very real potential problems for the euro, as well as the U.S. appears to be moving its alignment away from China and closer to Russia. More a bit on that in just a moment. Well, why more emphasis on a tactical approach? And that's a question that I've been getting from a number of people that I've been talking to over the last several weeks. Well, because the old rules for balance and diversification are no longer working in their traditional manner, and long-held relationships between asset classes have been breaking down. And this is an important part of the development of a tactical investing model to complement our fixed income and global equity models. And the 3 models that we use to get balance in our portfolios allow us to have greater flexibility and depth over the standard buy and hold strategies, and this will be even more important as we structure our investing process for 2017. As we showed last year the combined 60% equity, 40% fixed income benchmark provided a total return after fees and costs of 4.63%. Well, through 2016, the total return of an actual HYROX client portfolio with a balance of 60% equity and 40% fixed income, and a weighting combination in our models of 50% global equity, 40% fixed income, and 10% in the tactical model, well, that's well ahead of that 463 comparative benchmark for 2016. Now, a client who was invested in a greater amount of the tactical model had likely an even higher return. Again, we ask the question, why a more tactical approach? Well, because returns are relative. In order to understand the returns that you are getting, you also have to be aware of the risk that you are taking to get those returns, comparing apples to apples, so to speak. The combined benchmark 60% equity and 40% fixed income portfolio returns were 3.5 times per unit of risk taken. Now, our HYROX portfolio returns were 6.64 times per unit of risk taken. So in essence, they're almost twice as efficient. And this is where our clients benefit with better risk-adjusted returns. From a graphic perspective, with return on the vertical scale and risk increasing to the right on the horizontal scale, the HIROC portfolio not only outperformed the combined 60/40 benchmark portfolio, but also used less risk to do so. Again, better risk-adjusted returns. And that is why a more tactical approach works, lowering risk and getting the best possible returns for the risk taken. Well, as we also discussed last week, investors have grown more confident because clearly stock markets have built in a rather robust 2017, even with earnings already estimated to grow at 11.5% next year. Now, the 12-month forward-looking price-to-earnings ratio, which includes the next 12 months, as I said, is at close to its highs, near 17 times. And that is well above the 10-year average of 14.4 times. Well, yesterday Paul wrote a blog on our website about another metric with which we can measure the value of the S&P 500, and that's looking at the EBITDA, which is earnings before interest, taxes, depreciation, and amortization metric. On a price to EBITDA basis, like price to earnings, but using EBITDA instead of earnings, and also this metric does exclude the debt of the S&P 500 companies. As you can see, this metric has never been higher than it is today. So remember, this excludes the debt on the balance sheet of those S&P 500 companies, but really just the price of the stock. Paul's conclusion, it is the stock price that is driving overvaluation. Well, investors turn positive when they determine that U.S. companies may be in line for a 20% reduction in income tax based on President-elect Trump's new policies. And as Paul mentioned in his blog today, short covering has accompanied new buying that has driven prices higher, all in hope that what was promised will come to fruition. But all of this buying is pushing valuations to levels that to us just don't necessarily make sense. So we'll wait. And also, there's plenty of action on the geopolitical front this week, which is also raising the uncertainty levels. Today, in a much anticipated speech, Theresa May laid out her plan for a clean Brexit break and a renegotiation of trade with Europe with new, comprehensive, bold, and ambitious free trade agreement. Well, this certainly helped to give the pound a lift, especially because MPs in the UK will have a chance to vote on the plan. However, there is still lots of water to flow under that bridge before we get a sense of how this will all impact the UK economy. Another major concern that has arisen has been the relations between China and the US. At the annual meetings in Davos, Switzerland today, Xi Jinping was rather clear when he stated that countries should view their own interest in the broader context and refrain from pursuing their own interests at the expense of others. Clearly a message aimed at Donald Trump. And meanwhile, Trump appears to be going in a different direction. Well, turning to the International Monetary Fund's latest analysis, it has raised its forecast for U.S. growth based on the Trump agenda, but has warned that if protectionist trade proposals set off a trade war, it could be quite destructive for the global economy. So this is something we shall also have to stay very closely tuned towards. So here at HIROC, we will continue to monitor event risk and price valuation, and we will add or reduce holdings in our models as opportunity presents itself, and by preparing our strategies with continued deep levels of research as we did last year, and keeping in mind that our tactical approach allows us to add value and reduce risk to give us the best possible risk-adjusted returns. Paul, anything to add today?
Yeah, Scott, thanks. Just one thing I would add. We use this term tactical probably in a couple different ways, but number one is obviously, as you can see on that screen, the third name of our model, the name of our third model, pardon me. And the reason why it's named that way is because there are several securities in there. It's not just that we can go in and out and we're not married to positions for as long as we would be in fixed income or global equity, but I had lunch with a prospective client, old friend of mine today, and he asked about it, and I just said, you know, what it really means is that, yes, although we may not hold positions in there for multiple years, but we actually have, in a couple cases, we have long-term holdings in there. What it does really mean is that we go across the entire capital structure of a company. That being, we own some stocks, we own some preferred shares, we own some convertible bonds, we own some senior unsecured bonds. So it's more of a go anywhere depending on where we see value type of model. But away from that, and I think you've been referring to it a little bit, is even within fixed income and global equity, we are tactically investing, which means we are picking our spots and remaining disciplined due to our research. So tactical at High Rock has sort of two meanings. One is the name of a model, one is how we invest. And just one addition, just half an hour ago, we got filled on one position where I know the company very well, and I'm trying to be patient and just start legging into this one stock, buying it in the $12 range, and hopefully we'll be able to get it lower, maybe even into the $11 range, but I think by the end of the year this is a $20 stock. Otherwise, not a lot of changes in the tactical model or anywhere else. Thanks, Scott.
Yeah, and just to reiterate too, I mean, a lot of being tactical, not only in the tactical model, but also in our global equity and fixed income strategies, we are able to continue to reduce that risk component. And that's how we are able to get those better returns on a risk-adjusted basis. Okay, well, thanks, Paul. As always, thank you all for taking the time out of your busy schedule. I know this was a rather short. We're trying to keep these a little shorter, a little sweeter, so people don't have to spend a half an hour with us necessarily, unless there's a lot to talk about. But thanks so much for taking the time to tune in. If you are listening to the recorded version and you have questions, please feel free to send your emails to us. We are always available to take emails and answer questions, and look forward to doing so. In any event, stay tuned. We will be back with another webinar next week. Until then, this is Scott Tomlinson on behalf of Paul and Bianca, and we wish you all a wonderful week.